Good day, everyone. Garrett with More Financial Management here. Vanguard just released their latest investment market outlook, so I wanted to kind of share that with you all to give you an idea of what we might expect going forward. Of course, nobody has a crystal ball, Vanguard included. This is merely their educated guess, but I do believe it to be amongst the best in the industry, so I wanted to share it with you. So let's just jump right in. The first thing that I'll draw your attention to is the U.S. equity category. Anytime you hear equity, it's just a fancy word for stock. So think of this as the U.S. stock market. They are thinking annual gains going forward of 3.7 to 5.7% on average. That's a little bit lower than historical norms. So let's talk about what's going on there, and let me draw your attention to this next important piece, in my opinion. One is that the U.S. stock market is divided into two subcategories. One are what are known as U.S. value stocks. Two are what are known as U.S. growth stocks. Anytime you combine those two, what you wind up with is the broad U.S. stock market. Okay, when it comes to U.S. value stocks, they are thinking those are going to average between 4.6 and 6.6% per year, almost a full percentage point higher than the broad market on average. Conversely, they're thinking U.S. growth stocks are going to produce just 0.8 to 2.8% per year. Now, this is largely, I think, due to the fact that for the past 10 years or so, U.S. growth stocks have actually performed much better than value stocks. Now, Vanguard appears to be taking a contrarian perspective here, which I think is the wise thing to do. We've seen in the news a lot lately that just a handful of companies in the U.S. stock market are responsible for almost all the recent growth of the entire U.S. stock market. And in those handful of companies that are contributing to the growth are almost all technology companies. Okay. I think it was Jack Bogle that is famous for saying that trees can't grow into the sky forever. And that's basically what they're saying here, is that trend has to stop. And we're actually going to see a little bit of reversion to the mean, where value winds up performing better over the coming years. So that's where you're likely to see your growth come from. The next thing that I want to bring your attention to is this line right here, global equities ex-US. That simply means the international stock markets, okay? They are thinking those are going to average between 6.4 and 8.4% per year going forward, which is far more in line with what most of us think about or expect to earn when it comes to stock market investing. And let me pull this chart in here real quick because I think it kind of underpins Vanguard's thinking here. So this chart compares the U.S. stock market to the international stock markets. Okay, if we think of this center line as the average, anytime we are below that line, it means that international stocks are performing better than U.S. stocks. And anytime we're above that line, it means that the U.S. stock market has performed better than the international stock markets. And you can see that basically for the past 10, 15 years, the U.S. stock market has trounced the international stock market, okay, to the point where the discrepancy is about as wide as it has ever been. Okay, and the next important point here is that this has obviously been cyclical. Okay, it tends to go from one end of the spectrum to the other and back again. So Vanguard is basically making the argument, which I think is the correct one and a wise one, that this trend is going to revert. And for the foreseeable future, we might actually see the international stock markets performing better than the US stock market. And then the last thing that I want to touch on today pertains to the fixed income markets, again, which is just a fancy word for the bond markets. I'll draw your attention to this line right here, the U.S. aggregate bond market, which is just the average of all the bonds in the U.S. They're thinking about 4 to 5% per year, which is quite typical. Of course, 2021, 2022 were terrible for bonds as the Federal Reserve raised interest rates at the highest and fastest pace it ever had. That wreaked havoc in the bond market. The good news these days is that most people think that the Federal Reserve is done raising rates, and that the next time that we see some soft economic data or maybe even a recession, they're now in the position to potentially reverse course and cut rates. So big picture, we're back to relative normalcy in the bond markets. And that's everything that I wanted to touch on today. I hope that's helpful. If you have any questions about any of this, please don't hesitate to reach out. If you want to discuss how this pertains to you specifically, please also reach out. Appreciate your time today. Thank you, and hope you all have a wonderful Thanksgiving. I'll talk to you all soon. Bye-bye.